Hello there, everybody. I'm Catherine Nicholson. Thank you so much for joining this webinar today, where we're unveiling and formally launching the Climate Contribution Framework. It's a fantastic project, a practical, comparable, and sector adjusted way to measure corporate climate action. With us on the webinar today, we've got a whole team of experts to go through this project for you. We have Renaud Bedin, who's VP of Climate Impact at Sweep, Manuel Coeslier, who's head of Morova Research Centre. We also have Aliette Hubert, a consultant at iCare by Bearing Point, Guillaume Neveu, who's founder of iCare by Bearing Point, and Brad Shallett, Director of Sustainability Services at Winrock International. So today we're going to cover the three pillars of the climate contribution framework, the weighting logic as well, and we'll also get a practitioner's perspective from our special guest, Alexandre Marty, who's head of climate and natural resources at EDF. And we will, of course, have time for your questions. So and if you're not familiar with how Zoom webinars work, there is a Q&A box that you can find on the screen. Please do add your questions into the Q&A box at whatever point that they occur to you. You don't have to wait right until the end. If you want to ask your question to a specific member of our panel, then please feel free to mention that as well. So this webinar is scheduled to last for 45 minutes. We will send you the recording afterwards, and we'll also make the slides available to you as well. So to kick us off, taking us through the origins and the intent of the CCF, as we call it, over to Manuel and Renaud.
Thank you so much, Catherine. Welcome, everyone. We are indeed incredibly proud and delighted to present to you the outcome of this collaborative project, because this initiative was truly ambitious, and I would like to congratulate the whole team behind for successfully meeting the initial challenge that you presented, Catherine, measuring the positive climate impact of businesses in a fair, comprehensive, and comparable way. Initially, it was an intuition based on experience and real-life observations on the field by two key players of impact: Sweep, which is a SaaS company that enables companies to manage their impact using ESG data, and Mirova, and to be more precise, Mirova Research Center, which is a global asset management company dedicated to sustainable and impact finance. But nothing would have been possible without our technical partners, iCare by Bearing Point and Winrock International, who were selected through a call for tender. And we selected them because they were really complementary. Their complementary skills were a significant asset, I would say, in this project. So I want to sincerely thank and congratulate them for their commitment. The climate contribution framework was designed for and with companies, with businesses. So we would like to thank our 10 sponsors for their incredible commitments, including their efforts in testing the methodology over the past few weeks. And I also wanted to mention that the framework is not intended to be a new methodology, I would say like a new standard, but a meta framework that consolidates and harmonizes existing frameworks. To ensure this, we relied on an observer committee, international experts, and I wanted to thank them a lot. Manuel, over to you.
Thank you, Renaud. Let's have a quick zoom on how this framework came to life. So it started, as Renaud described, with selecting the best partners, and then an intensive 6-month sprint to develop the methodology, conduct a stakeholder consultation during New York Climate Week in September, test the approach with sponsors, then we'll have Alexandre from EDF describing the results later in the webinar, and present it as well at the latest COP, at the last COP, as part of the action agenda. And now to you, along with the publication of the white paper this week. And now I'll hand over to Renaud to share more about the collaborative process and milestones on the project?
Yeah, let's start with a soft vision of the methodology, I would say. So a general overview. So we believe that companies, they play a transformative role in moving collectively towards a net zero world. But this broader contribution, meaning going beyond the simple footprint reduction, is currently neither recognized nor measured and therefore underfunded. So beyond taking into account like other action than just reducing CO2 emission, we believe that the framework is filling three major gaps. First of all, it brings nuance and fairness. This methodology you will discover differentiate the role each sector can play, seeking to ensure fairness in the effort made towards global net zero. Secondly, the framework enables robust comparison. Let's be clear, it's currently impossible to make a robust comparison of companies of their comprehensive climate action. The climate contribution framework enables this comparison both across industry and between companies. And lastly, the climate contribution framework is trying and is unifying the landscape of climate action standard. By unifying diverse standards and practices, we are reducing complexity and creating a universal framework. This provides a common operational language that could underpin regulation, trade, and of course, finance. The climate contribution framework is a meta framework that reveals the real contribution of companies to global net zero. It provides the first tool that quantitatively scores a company's efforts against a holistic set of climate mitigation levels. More specifically, and Manuel will explain it to you, the framework is based on three levers: carbon footprint reduction, climate solution dissemination or deployment, and climate financing. These levers are weighted by sector to capture a company's fair contribution to the climate transition. Manuel, I'll let you go into detail.
Yeah, so the climate contribution framework, as Renaud described, is built on three non-fungible pillars, each capturing a unique way companies can drive climate progress. So we have pillar A, carbon footprint reduction. This pillar measures not just emissions cuts, but also ambition, governance, transition plans, and engagement across the value chain. It's about credibility and maturity of a company's decarbonization strategy. We have pillar B, called climate solutions dissemination. Here we recognize companies whose products and services enable emissions reductions elsewhere. This includes current green revenues, future ambitions, and the real-world impact of solutions quantified by avoided emissions. And we have pillar C, climate financing. This pillar values voluntary financial contributions to climate change mitigation, even beyond a company's own value chain. It covers a broad set of instruments, from high-quality carbon credits to climate-focused investments and philanthropy. Each pillar is scored from 0 to 100 and then weighted by sector. So the framework reflects what's most material for each industry. For example, heavy emitters are primarily assessed on pillar A, while solutions providers may have a higher weighting on pillar B. This approach ensures fairness and comparability while preventing strong performance in one area from compensating for weak action in another. Next, Renaud, please. So the framework delivers three key outcomes for every company. First, the contribution potential. What's the maximum a company could contribute given its sector? This is based on the sum of the sector's pillars weightings, alpha, beta, and gamma, reflecting climate materiality in a given sector. Second, the actual contribution. What is the company actually achieving right now across all three pillars? adjusted for the credibility of the data and frameworks used. And third, the contribution performance, which is the ratio of actual to potential contribution, showing how effectively a company is acting on its climate potential. Let's look at two examples quickly. A media company with a high potential and strong scores across pillars might achieve a contribution performance of 92.5%, a true leader, for example, while an automotive manufacturer with lower scores and a higher potential might only reach 30%, highlighting a gap between what's possible and what's actually delivered. Next, please, Renaud. So here is how the results come to life. A single, powerful visual combines pillar scores and sector ratings. At a glance, you can see the company's actual contribution, its sectoral dependent potential, and its overall performance as a percentage, in this case, 26 out of 93. This visualization isn't just for benchmarking, it's a diagnostic tool. It helps companies, investors, financial institutions, and stakeholders quickly spot strengths, gaps, and where to focus improvements efforts. It also enables two axes of progress, improving demonstration through better measurement and third-party evaluation, and strengthening action by raising ambition and execution on the most material levels. Ultimately, this tool supports credible, transparent, and actionable leadership, moving us from compliance to real rewarded impact.
Thanks. So this framework is made for companies, financial institutions, investors, and the whole ecosystem. It is designed to serve the entire ecosystem. Companies first, because it will enable them to prioritize high impact contribution actions and chart a pathway to continuously improve their scores. Financial institutions, they could gain a better comparability between companies, a robust benchmark to differentiate leaders, guide engagement, and as needed, allocate capital. And then policymaker and all other climate action enablers, they will be able to use the framework to facilitate a more comprehensive understanding of global corporate climate action.
Lovely. Thank you so much, Renaud. Yeah, we're going to hand over to Aliette now to look at the pillars scoring, starting with the generic formula, and then Aliette, if you can move us on to pillar A.
Thank you, Catherine. So the Climate Contribution Framework scoring system is designed to balance simplicity with methodological rigor. Each sub-pillar score is calculated using a generic formula built on three factors. The assessment quality first, which reflects how reliable the underlying evaluation is. An audited evaluation is considered more reliable than an unaudited one. Secondly, the assessment framework. Some frameworks are more complete or demanding than others, and this is reflected in the score. And lastly, the performance score, which is the actual rating or result assigned to the company by the chosen framework and reflects its level of climate performance. So let's start with practice to illustrate the theory. Can you go back, Renaud, please? Thanks. For example, Pillar B on climate solutions assesses, among other things, the share of a company's revenues derived from climate solutions. Numerous frameworks can be used to define what qualifies as green. Of course, the EU taxonomy, but also the Climate Bonds Initiative taxonomy, the IEA ETP Clean Energy Technology Guide, and other well-recognized or internally designed classifications. Based on these, we can compute the share of green revenues, which translates into the performance score. So the CCF logic, scoring logic, was intentionally designed to harness the outputs of all these existing frameworks. These framework outputs constitute the quantitative backbone of all sub-pillars. So translated onto a 0 to 100 scale, this performance score answers the question, how does my company perform under a given assessment framework? It reflects the company's actual achievements and progress within a given pillar based on assessment outputs from existing frameworks. However, not all frameworks or their applications are equally complete and demanding. Therefore, a share of green revenues audited and calculated by a company using proprietary data and EU taxonomy guidelines will not be treated the same as an unaudited estimate based on an internal taxonomy. And this is where the assessment framework score and assessment quality score act as credibility enhancement factors. They ensure that performance scores are adjusted to reflect both the transparency and completeness of the framework used to assess performance and the rigor of its application. That is, the robustness of the underlying data, the independence of the assessor, and the level of audit assurance. Thus, a company assessed through a well-established and transparent framework, supported by verified data and independent evaluation, receives higher recognition than one relying solely on self-declarations or less reliable default approaches. So let's see how it looks, starting with Pillar A. So Pillar A evaluates the extent to which a company reduces its greenhouse gas emissions across its operations and value chain, as well as the tools and policies it deploys to support that effort. It is structured around 5 sub-pillars aligned with international guidelines for assessing the credibility of a company's transition plan, such as those developed by the Assessing Transition Plan Collective, ATP-COL. So sub-pillar A1 on past and current performance aims to capture and recognize companies' historical decarbonization efforts and its current operational footprint, including companies engaged in intrinsically low carbon activities. Sub-pillar A2 on metrics and ambition aims to capture and recognize companies that set ambitious emission reduction targets, taking into account both long and near-term goals, the level of ambition and the boundaries of the emissions considered. Sub-pillar A3 aims to capture the role and means, whether financial resources or value chain engagement strategies that a company must mobilize to advance its decarbonization journey. So it evaluates the robustness of the transition plan and the company's engagement across its value chain. So implementation strategy, supplier engagement strategy, and customer engagement strategy. And finally, sub-pillars A4 and 5 capture the governance structures supporting climate action and alignment between public engagement and climate ambition, respectively. So many different frameworks may be mobilized to capture the company's performance in each sub-pillar. For example, a company may have set an ambitious 1.5 degree target validated or not by the SBTi or by TPI carbon performance. All such illustrative cases can be integrated into sub-pillar A2 scoring. And any of these framework outputs are translated onto a common 0 to 100 scale using a dedicated conversion system, also called the CCF translation kit. This approach enables the continuous expansion of the list of mobilized frameworks, while ensuring that the final score is adjusted to reflect the completeness and transparency of each framework through the assessment framework scoring grid. For companies that have not been assessed by any external frameworks, CCF simplified approach has been designed, enabling a rapid and less granular assessment of every company on each sub-pillar. Although this approach is less robust, which is reflected here in the lower assessment framework score on the slide, it allows companies to reward the actions they are already undertaking, and it can draw in particular on existing disclosure and reporting data, including CSRD. So here on the slide, we illustrated only 2-3 frameworks with indicative values, but we have integrated a much broader set of well-recognized frameworks, SBTi, Influence Map, ACT methodology, TPI, CA100+, etc. And this list will keep expanding. Finally, if a sub-pillar is assessed through multiple existing frameworks, the highest resulting score is retained. And this principle ensures that being assessed by more than one framework is always beneficial and never penalizing. For instance, a company may have validated a well below 2-degree target with the SBTi, while also having developed an even more ambitious internal pathway. And the CCF methodology accounts for both pieces of information and retains the better score, while adjusting for the difference in authority and independence between the two frameworks. And that concludes Pillar A, Catherine.
Lovely. Thank you so much, Elliot. Very comprehensive and clear overview there. Could you take us through Pillar B as well regarding climate solutions?
Yes, sure. Pillar B is designed to recognize companies that contribute to climate change mitigation by enabling emissions reductions elsewhere through the deployment of low carbon products and services. So it captures the role of solution providers whose core offerings help other actors reduce, avoid, or remove greenhouse gas emissions. It is here structured around 3 sub-pillars. Sub-pillar B1 measures the share of current revenue derived from climate solutions based on recognized taxonomies and eligibility frameworks. Sub-pillar B2 rewards companies that forecast and plan to increase their climate-aligned activities. And finally, one of the key goals of the climate contribution framework is to integrate the magnitude of impact of solutions today, expressed as a ratio of avoided emissions to induced emissions using standardized methodologies. So these raw climate-related outputs, green revenue, avoided over induced ratio, etc., are translated into a 0 to 100 normalized performance score using calibrated maturity matrices following the dedicated translation kit approach as in Pillar A. Moreover, the assessment framework and quality scores ensure that these quantitative outputs are properly adjusted to reflect both the robustness of the methodology used and the rigor of its application. For example, a company may disclose its green revenue calculated internally using the EU taxonomy and supported by a formal audit. However, it may just as well rely on another framework, such as the Climate Bonds Initiative taxonomy or an internally designed classification. In other cases, green revenue may be estimated by an independent data provider based on the EU taxonomy or another relevant framework without undergoing an audit. So many such use cases exist, and all can be incorporated into the CCF to assess a company under sub-pillar B1. However, they are not treated equally. The final score depends on the underlying data, the assessor, the auditor involved, and the robustness of the framework used. The EU taxonomy, for example, here receives a high robustness score because it is developed by a broad coalition, including NGOs, academia, public bodies, includes do not significant harm criteria and technical screening criteria. And back to you, Catherine. Thanks.
Lovely. Thank you so much, Elliot. And just to say thank you to the people who are already putting questions in our Q&A box. Please do keep adding your questions. We will come to them in our question and answer session. But right now, let's move on to Pillar C with Brad Shallett, who's Director of Sustainability Services at Winrock International.
Thanks, Catherine. Yeah, so in the climate contribution framework, we wanted to reward companies who are investing in climate action, investing dollars in it, right? Because currently in the climate standards, we didn't feel like there's enough of an incentive for companies to do those investments. Right now, companies can have their inventories emissions go down for reasons that are not related to their actual actions. So again, we wanted to incentivize this companies to invest. And so, yeah, we'll dig into that in the next slide here, the detail here. So our goals were to incentivize a broader set of climate finance solutions, not just carbon credits. And we think that carbon credits can be a very robust mechanism, but it's not inclusive of all the types of climate financing vehicles that are out there. I did want to provide a few clarifications for what's in scope in Pillar C climate financing though. First, CapEx and OpEx investments related to value chain emissions are actually assessed in Pillar A that Elliot mentioned earlier. In addition, Right now, we are including value chain associated environmental attribute certificates, or what SBTi is called EACs, in Pillar A as well. Those are financing vehicles, but we're considering those in that pillar. And then third, the other exclusion that we have here is we're not assessing lobbying in lobbying dollars in terms of how they're spent on climate policy. It's just a really difficult investment to assess and determine the amount of dollars that are related to the lobbying for the climate policy versus other types of policy. So that's an exclusion as well. Just back to the goals here, one of our goals was to make sure that we're assessing the fair share of a company's ability to invest in climate finance vehicles. Not all companies have the same profitability levels. In this assessment, part of the assessment methodology, we are providing a nudge for companies that have higher profitability to make those investments. In a similar vein, we have a sector adjusted weighting for companies on how much they should invest in climate finance. Manuel mentioned that earlier. So like other pillars, this is sector adjusted as well. Going on to the assessment framework itself, it follows the generic formula pretty closely. We have an assessment of the quality of the data, whether that data was third-party assessed as well for that climate finance vehicle. We're looking at the framework that the climate finance vehicle was assessed under as well, and the robustness of that framework, and then scoring that. So an overall sense of the quality of the climate finance vehicle comes out of this section of the methodology. We also are looking at how much money is spent on those interventions, on those climate finance vehicles, and that's what's happening in the far right column here with performance. So shifting back to the other side of the slide here in the blue column, this is what we're assessing in terms of the different types of climate financing vehicles. The first are voluntary ton-denominated instruments. And why the jargon there? Why didn't I just say carbon credits? Well, not everything is a carbon credit that is ton-denominated. There might be some cases where a company is investing in a really great intervention that didn't quite go through the full carbon crediting procedures to be issued on, by a registry. So we wanted to be, again, inclusive of all types of ton-denominated instruments there. C2 is non-ton denominated instruments. There could be cases where you're investing in climate action, but it just hasn't delivered a ton yet. So an example here might be that you're investing upfront in a landscape and that landscape would eventually generate REDD+ credits. But there's a lot of upfront financing that may need to go into that, and it's very valuable. It's needed to unlock the transformation, but we wanted to make sure, that non-ton denominated climate finance was assessed here. And then finally, the last one is investments with secondary climate impacts. So the goal of an investment might actually be biodiversity improvement, and climate is sort of a co-benefit to that. But we wanted to create a vehicle to assess those types of things as well. And so just to look at an example of how the methodology might play out here with ton-denominated instruments, there's the Integrity Council for the Voluntary Carbon Market. Let's say there's a credit that was assessed by or approved by the ICVCM. That would get top marks under this assessment system. And similarly, ICROA endorsed crediting programs would get top marks. I mentioned earlier about the different, there might be ton denominated instruments that that are not quite carbon credits. We would have, and we do have in the white paper, which will be released on the 27th of this month, more detail on how we could do a simplified assessment of ton denominated instruments. And then finally, if we look at the other C2 and C3, non-ton denominated instruments and investments with secondary climate impacts, there's not really a methodology out there that we can use that's been developed yet, right? So we have developed through our the simplified approach a way to assess those instruments, and again, that's in the white paper. So I did mention the final part I'll say is that in the performance section, in this green box in the bottom right corner, the way I'd summarize that is that we're incentivizing companies that have higher profitability to invest more in climate action here. So there's a multiplier that's been created to create that incentive. And with that, I will turn it back to you, Catherine.
Thanks so much, Brad. That was great. And a reminder to everyone watching the webinar that you will get these slides afterwards so that you can go through them in more detail. Let's move on now to Guillaume Neveu, founder at iCare, to take us through the weighting logic of the CCF.
Yeah, thank you. Thank you, Catherine. Sorry, can you hear me?
Yes, we can hear you. Just a little echo there, but it's good now.
That's great. Thank you. So now the question is, you've seen all the methodology per pillar, and now the question is, how do we combine actually all these three pillars? And if we go to next slides, actually that's I would say the second added value of this framework is to provide actually a vision on what is expected from companies on each of these pillars, and this on a sectoral basis, that it was already said by Manuel and Renaud. We did this work for more than 100 different industries to say, based on algorithm, which is the weight I should put on each of these pillars. So let's start with the pillar A. So the pillar A, the weight that we calculate for it is the letter alpha. And how did we do that? Actually, the pillar A is anyway the predominant one, for sure. We still keep, although we have added to be comprehensive and holistic, pillar B and pillar C, we still want to make and still to maintain the maximal pressure on the emission reduction, which is a pillar R. And naturally, the criteria for it, and the main one is the carbon intensity of all scopes, scope direct emission, but also indirect emissions, upstream and downstream, to consider is the materiality of these sectors for the climate. And we do that first on a criteria of carbon intensity, but also with a second criteria on how in absolute value these sectors are contributing to the climate change. And for this alpha, we give the maximum range among the different pillars, which is from 5% to 80%. So that's for pillar R. Then if we go to the climate solutions that have been described by Aliette earlier, then we put a weight of beta, which is also important, but also in the range, we arrange it as so that it is less globally important than the pillar R. So we have a range from 2 to 2.5% to 60%. How did we do actually to say what is the weight we should attribute to this pillar? Basically, it's the ability of each industrial activity, each economic activity, to have solutions within its, I would say, natural range of activities. So if I'm acting, for example, in the mining industry, is it possible that I have in my range of activities the ability to go on the mining of transition materials and transition metals, for example? If I am in the electric industry, do I have access to renewable components, as an example? So we have, and you'll see that just afterwards, specific questions that made us enable us actually to put the right weight based on the ability, the theoretical ability to go and catch the climate solutions. And then, so the last pillar, the pillar C, that was described by Brad about this climate financing potential. Here we wanted really, we are now, I would say, beyond the direct responsibility of the company on its scope and its solution. So we are more on the voluntary aspects. And of course, although we want to valorize that, and that's why we put the pillar C in the whole system. The weight that should be attributed to this pillar is more complementary to the others. That's why we have a lower range from 2.5% to 10%. And here again, the criteria sector by sector was based on the ability to have, I would say, the margin, the cash, the economic possibility to fund this voluntary climate financing, which is one thing. And the other thing being, I would say, the historical responsibility of somehow financing on a voluntary basis. The emissions that have been made by this sector in the past. So when you see all that, then, and you see the graphic here, you can add it up. None of each pillar is actually compensating each other. And that's very important at the end, that yes, there is a global score, but there is a score per pillar, and there's also a score per sub-pillar. We don't want to have a black box here. But anyway, the idea is that when you sum it up, you get also what is the society expectation regarding this sector, what we call the potential. And it can be a maximum at 100. It can be at the minimum of 10 when you add up the minimum of each of the weighting factors. And you'll see later on how it can be in a real example. If we go to the next slide, just to understand, it was not an expert judgment from Winrock, iCare, or Mirror, whatever. We define an algorithm based on a few questions, actually, that have been set up for each sector, based both on the quantitative assessment with carbon intensities, and then also specific questions that could be answered for each of the sector. And then we come up to, as already said, more than 100 configurations for different sectors. And you see here the variety of results. Of course, and we thank you also, EDF would show a real example, but production of electricity, as we expect, we have a high score. This high score globally is made of a high alpha. You see here that it is a predominant, but also a high beta, because the electricity sector is both having a strong, climate intensity legacy, but also the ability to have in its portfolio low carbon solution. So you combine both a high alpha and a high beta. And then, as already said, the statistics of margin per sector makes the gamma as a complementary aspect. On the other hand, if you go to the right, then you have manufacture of batteries with also a high expectation. And here you see that the balance between alpha and beta is reversed compared to production of electricity. Yes, indeed, batteries is a metal-intensive and carbon-intensive product and industry. That's why the R and the alpha is significant. But the battery is also a tremendous enabler of the transition for the mobility, for the renewable. And that's why here you have a beta, which is actually higher than the alpha. Again, I don't comment the gamma. And then if you come to other activities, and that's also the purpose of this framework is to be able to capture all economic sectors. Software publishing, which is maybe not what we could thought as, a material sector, but actually, as you know, the digital is not a free lunch, and you have indeed on your whole value chain a carbon intensity. That's why you have also an alpha, which is lower than the battery and the electricity production, but still, which is significant. And you have also the power And that's the use case also of Sweep as an example, but to be able, as a software, to be also a solution and enabler of the transition. So we expect also the software industry to be also provider of solutions. That's why you have also here alpha, beta, which is at the end of the day, a global score, which is of 62, a potential, which is high. And then, I mean, business consultancy, the case of iCare as an example, not intensive, fortunately, but also with high expectations for each consultancy to be able to help also the transition and include in its portfolio green activities. That's why the beta is also higher than the alpha. So that just gives you a view of, on more than 100 activities, how we provide in this methodology these weighting factors. And I'm done.
That's great. Thank you so much, Guillaume. I think it would be great to give everybody a practical view of you from a practitioner. So we're very pleased to have with us today Alexandre Marty, Head of Climate and Natural Resources at EDF, which, as you may know, is Europe's largest electricity generator and the world's biggest generator of low carbon electricity. EDF also one of the sponsor companies of the Climate Contribution Framework and has tested it out. So as such, EDF has some very valuable real world insights on how it works and the value that the CCF can bring. So Alexandre, first question to you. Can you tell us why EDF chose to join this initiative?
Thank you, Catherine. Sure. I mean, there's several reasons, but I'll name maybe three. The first one is that our low carbon profile, as you said, is fairly low, and it's actually a challenge for a number of existing frameworks that were designed to assess the transition of an average player in a given sector, the transition to net zero, and starting for a fairly high level of carbon intensity. So those frameworks, they often overlook past and current performance, and they treat us as any other player in the industry, which is indeed a challenge for us. The second reason would be that a significant component of our strategic project is actually revolved around the deployment of climate solutions, in particular in our sector, the electrification of energy uses that will ultimately displace the use of fossil energy. And so this goes beyond action on our own carbon footprint, as we do a lot to promote climate solutions beyond the scope of our direct customers. And that's actually what is at the heart of Pillar B, which is poorly recognized by most frameworks today, even fairly complete transition plan assessment frameworks such as the ACT framework, for instance. And the last reason would be that we feel that our primary responsibility in the power sector lies both on pillars A and B, and less on C, but we had no means to objectify that and to quantify that. And this is actually one of the key innovations of the Climate Contribution Framework, that way to weight the expected contribution across the three pillars that Guillaume just presented.
Great, thank you so much. It's very clear. Can you tell us what you or EDF learned from testing the CCF and from the results, of course, that it generated?
Of course, and we'll show you in a second the assessment for EDF. Maybe I'll say just a few words on the rating process itself, which was a very good experience overall for us. It makes the most of the existing assessment out there, and the simplified approach, which is embedded in a framework, works quite well actually for Pillar A. The volume of data required is very reasonable overall. Some data were not readily available for us, especially in Pillar B and Pillar C. But in our case, I think it's mostly down to the specificities of the sector where we operate and to our corporate structure. I guess it should be more available to most other corporates. On the results themselves, so overall, reflects well our perception of where we are expected to perform and how well or how poorly we perform on the different components of the assessment. The weighting of the three components looks okay, with indeed pillar A and B representing most of our expected contribution. They represent actually 93% of our expected contribution. On pillar A, the scoring really leverages the different standards against which EDF is assessed, ACT, TPI, the net zero assessment of Moody's, SBTI, influence map. You can see on the slide that really the scoring uses all the output of all those different standards against which we have been assessed. The results also show areas where our performance could benefit from a better recognition. For instance, on avoided emissions, where we rely on our own internal methodology, and even though that methodology is audited, the CCF actually encourages us to rely on external approaches that would enhance the robustness and the comparability of our performance. It also points areas where our performance is lagging behind, our pure performance is lagging behind expectations. For instance, on offsets in pillar C.
Lovely, thank you. And in your opinion, what sort of conditions would be needed for there to be broad adoption of the climate contribution framework?
Well, I guess this is one of the key questions, and I can only give you my perspective, and Manuel and Renaud will also be able to jump in, I guess, at the end. But I mean, to us, overall, the governance of the initiative, I think, needs to ensure the right balance between, on the one hand, credibility and comparability of the assessment, and on the other hand, flexibility and cost efficiency of the assessment process. So it means that we're probably going to need a process that will involve sort of qualified third parties that will review the corporate data and process it through the scoring tool that has been developed actually to calculate the scores, and obviously the review will be made easier if it can rely on information which is made publicly available by corporates. And I guess broad adoption by corporates will work hand in hand with broad adoption by investors and financial institutions, as well as broad recognition by stakeholders and policymakers. So it means that we may have a chicken and egg dilemma here. So I guess to start with, I think it will take some committed corporates on the one hand, committed investors and financial institutions on the other hand, to rise to the occasion and to create a momentum. And adoption by every established framework, such as the Climate Action 100+ or the Net Zero Investment Framework, I think could have a tremendous accelerating effect on the adoption of the framework. But in any case, you can count on EDF to support all those efforts.
Excellent. And we're really happy to have EDF as one of the sponsors of the Climate Contribution Framework, of course. Thank you so much, Alexandre. That was a really helpful look at how that worked out for EDF using the CCF. We've just got a couple of minutes to go back to Renaud and Manuel very, very briefly to tell us about the next milestones for this project.
Yeah, thank you. Time is running out. So yeah, basically we got to follow the EDF Alexandre recommendation. But yeah, I mean, the really first step is tomorrow, because you will receive the white paper. So yeah, feel free to read it. And secondly, we want to collect your feedback. We want to present the white paper to different audiences and to collect these stakeholders. It's a kind of a stakeholders. It's not a real stakeholder consultation, but it's an open channel. We want it to be as collaborative as possible. So please feel free to share your feedback with us. And then in 2026 and in the next coming years, I would say, we are looking for strengthening the governance. It was part of the question, and this is really key. So the idea is to organize the best representation as possible of the whole ecosystem. Of course, we need to refine, develop the core methodology, and yeah, we want to improve the framework. And then we have to make this methodology alive. So we have to assess companies on a public and private data. If you are interested in, please feel free to reach out to us. If you want to be assessed, if you want to test the methodology, we need you to test it. And yeah, I mean, we are looking for money because we need money for doing all of these, and of course, still keeping in touch with the whole ecosystem. This is really key for us.
Lovely. Thank you so much, Renaud. And we are slightly over time, and I see that our panel has actually answered pretty much all of the questions already in the Q&A box. But yeah, as we said, we'll be in touch with you following the webinar to share the replay of the webinar, also the slides, the white paper. So you have plenty of information, and there should be ways in there for you to get in touch. Of course, if you would like to give feedback, get involved in the pilot, the working groups, there are plenty of ways that we'd be very keen for you and your organizations to get in touch with us and get involved as well. So thank you so much to everybody who's been along with us for this webinar today. And in particular, thank you very much to our panel for sharing all of these insights onto this exciting project. So yes, thank you very much, everybody, and see you soon.
Thank you.